Hello and welcome to today's Wyoming SBDC Network CARES Act Recovery Program webinar. My name is Maureen Johnson and I'm the CARES Act Marketing Coordinator with the Wyoming SBDC Network. We're so glad you've joined us for today's presentation, Mastering and Managing the 4 Key Financial Performance Drivers for Business, presented by Steve LeFever of Profit Mastery. The Wyoming SBDC Network is a University of Wyoming program available to all state residents and is funded by the Wyoming Business Council and the U.S. Small Business Administration. We provide no-cost confidential advising and technical assistance to all Wyoming entrepreneurs and small business owners. Wyoming SBDC Network advisors are located throughout the entire state. Due to the COVID-19 pandemic, we are mainly meeting with clients virtually, while we look forward to meeting our clients face-to-face again in the near future. We work with businesses in every industry from technology, retail, service, energy, and more. Our advisors help new businesses get started and help current owners respond, grow, reinvent, exit, and recover from challenges. Speaking of challenges, we know that many Wyoming businesses are experiencing the impacts of COVID-19. As a response, the Wyoming SBDC Network is operating this CARES Act recovery program that is made possible by the Small Business Administration funds from the Congressional CARES Act. This program allows us to bring on a number of supplemental advisors and webinar presenters like Steve, who bring their expertise in topics and industries that most affect Wyoming business owners. We are able to offer their training and one-on-one advising to you at no cost to assist with your COVID-19 recovery so you don't have to manage these challenges alone. Thanks for having us, Steve, and thank you for being here today.
Hello, and welcome to Profit Mastery. I'm Steve LeFever, the founder and CEO of Profit Mastery, and for the next 3 weeks, I'll be working with the Wyoming SBDC, as you just heard, to bring you an overview of the incredible amount of financial intelligence that you can find in your very simple statements, a balance sheet and an income statement. That's what we've been doing for over 3 decades. Profit Mastery was formed about 31 years ago here in Seattle, where I'm located. At the time, I worked at a bank, and I realized that many of our business customers, they were really good at making it, and they were really good at selling it. And they weren't necessarily really good at the financial side, and we were loaning them money. So I put together, after some difficulty with my senior management, I put together what is now the Profit Mastery program. Over the last 30 years, we presented this program to well over 2 million business owners on 3 continents, 20,000 CPAs, 20,000 bankers. So hopefully you'll enjoy this program as well. The goal of this program, these are 3 really relatively short programs over the next 3 weeks, about an hour, 45 minutes to an hour, to outline the possibilities. My goal is not to teach you. These are excerpts from our 16-hour full 2-day program. But what will provide you is an awareness of the tremendous opportunities to go inside the numbers, okay? All right. So that's me. And I'm your facilitator for the next couple of weeks. I hope you'll join me. Thanks for joining me today. Our sponsor, as you know, is the Wyoming SBDC. I'd like to thank them and the SBA, as well as Bruce Morse there in Wyoming, and Tara Kuipers, who is the CARES Act contact for the Wyoming SBDC. So thank you very much, and I'm glad to be here. Just a little bit about Zoom. You may or may not be familiar with it. Zoom is the platform that we're using here. You'll be muted. You'll see me in an inset view in the upper right-hand corner. Probably. I will not see you. There are lots of you, and so that's not going to work. At the top right, make sure you're watching in speaker view. If you see the word gallery view, you are already in speaker view. If you see the word speaker view, click on it so you'll get to me, okay? The session will be archived and can be accessed in a few days through the Wyoming SBDC website, okay? If you decide you want to watch it again, you have friends that want to watch it, et cetera, all right? So here we go. Over the next 3 weeks, we're going to take an amazing journey, not the one you see on TV, it may be amazinger, inside the numbers. We're going to go inside the numbers, and we're going to unlock the tremendous amount of financial intelligence that is contained in those two simple statements, a balance sheet and income statement. And again, what I'm going to do today is not a full-blown presentation of Profit Mastery, but I want to hit the highlights. We said the 4 key financial tools that are available using only your financial statements. One of the things that my business customers used to say is, I don't need to know the numbers, my accountant handles that. Interestingly enough, while I worked at the bank, we never got the accountant to co-sign the loan. So my customers needed to know their numbers. And what I learned was, if you don't know your numbers, you don't know your business. It's as simple as that. We're going to make metrics matter. That's what Profit Mastery is all about. I've also had people tell me, my numbers are boring. My view on that is, if your numbers are boring, you got the wrong numbers. And I'm going to share with you a process that has worked all over the world, as I said, with literally millions of business owners, okay? Here's the profile. If there's 2 people involved in a business out there, traditionally, one person knows how to make it, and the other person knows how to what? And I'm guessing some of you maybe lip-synced spend it, and that's the wrong answer. That's family finance, okay? That's an advanced program. The other person knows how to sell it, right? That's the strength of the business community typically. They know how to make it and they know how to sell it. The weak link, the Achilles heel, if you will, the albatross is finance. It always has been. And we know that 80% of business owners go away, which was a daunting number for me when I joined the bank here in Seattle. What I realized was I had a 4 out of 5 chance of guessing wrong. And what I realized further was I needed to help address that. My background was as a business owner too. Before I got to the bank, I built up a business from 17,000 in sales the first year to a little over 10 million the 4th year. And we made all the mistakes it's possible to make. That's what we put into Profit Mastery along with my colleagues, okay? So the financial side is often left to whom? The accountant, the banker, here's what people used to say. I've been doing this a long time. They used to say, the wife. As it turns out, who's starting businesses in America today? Women are starting businesses at a rate 2 to 1 over men. And the failure rate of women-owned businesses is lower. Now, I'm not going to go into some pop psychology analysis of why that probably is. Maybe they do ask for directions. I have no idea. The interesting thing is, though, the principles of finance, which we're going to be talking about here this morning, they don't care about age, right? They don't care about age. How old was the colonel when he started KFC? 67. So it doesn't matter when you start. The principles of finance don't care about age. They don't care about gender. They don't care about ethnic background. They don't care about where you are in the world. They all work. Everywhere I go, the principles of finance, nobody's invented new ones. So what we're going to talk about today, doesn't matter what kind of industry you're in, whether you're in a manufacturing facility or a wholesaler or a retailer or a service business, These principles apply to every business out there, okay? My word for the process, the profit mastery process, very simple. Measure. Measure. What gets measured gets managed, and what gets managed gets done. I guess another way to say that is if you can't measure it, you can't manage it. You've got to be able to measure it, which means you got to have good data. And that was one of the things that in all of the SBDC affiliates around the United States that we've worked with for over 2 decades, that's one of the challenges, is having good data. If you don't have good data and you make decisions based on bad data, and I've had people tell me, this is just my little pitch for getting good data. I've had people tell me, good data is really expensive. Here's what I'll say to that. If you think good data is expensive, try working with bad data. It just ain't gonna work out. Gotta have good data. So we always provided good resources out there in the accounting profession. There are good accountants everywhere, but you gotta know what you want, all right? When I was a banker, I used to say to my business customers, you gotta measure. And they said, measure what? And I said, well, you gotta measure the key drivers. And they said, cool. The key drivers of what? And I said, well, 2 things. NP, which is what? Of course, net profit, and CF, which is what? Cash flow. And this brings me to one of the biggest myths out there in the business community. If we have profits, we will surely have cash. True or not true? Obviously not true. Here's the picture that emerges. Profits and cash. 2 different cycles. We know we got to have profits, and that's been a challenge over the last 8 months for a lot of businesses. We know even more we got to have cash, right? We got to have cash. 2 cycles, a profit cycle and a cash cycle. Do they overlap? Yes, sometimes a little bit, sometimes a lot. But they're 2 distinct cycles with 2 distinct sets of drivers. Which do we have to manage? Both of them. Simple as that, okay? Put an umbrella over this. What you really got to measure is performance. And we've seen the profile of businesses changing over the last 8 months. And we'll get to that when we talk about cost structure here in a couple of minutes. Got to understand where we sit and how we can make decisions. I wanted my customers, and that's the goal of Profit Mastery, is to use financial metrics to be a better business owner and make better business decisions, all right? So here's the picture of Profit Mastery. And by the way, you'll find in each of the modules of Profit Mastery, there is a visual. I believe one of the taglines we use is, finance is the medium, but communication is the message. And I see 3 ways to communicate out there: numbers, words, and pictures. I think we can mostly agree that finance is numbers, but that's the hardest way for people to communicate. What's the easiest way? Pictures, right? So we came up with a concept we call visual finance. There's a picture in each one, and here's the first one, right? Financial performance is like a 3-legged stool. You can see that. Take a leg away. What happens? Stool falls over, right? So education is the foundation. Benchmarking or information is the yardstick. And what's the contractor's mantra? Measure twice, cut once, right? Measure twice, cut once. Back to that theme, you got to have good data. And finally, accountability establishes the discipline to do this. And across your state, you have a group of SBDC counselors. You heard Maureen tell you, their services are complementary. They are there to help you implement the tools of finance and the tools of profit mastery. So you're not by yourself out there. All right. So when I was putting this program together, I needed help from my bankers that I worked with, about 30 of them. I went into the lunchroom and I said, hey, give me your top 10 things, your top 10 things you wish every business owner knew financially when you walk in to see them. What are the top 10 things? And this is 30 bankers wrote out 10 things. I said, these are the things that come up over and over again in your communication. Well, I had 300 things, and I started putting them in buckets. I cut them into pieces, and I started putting them, because a lot of them were common. How many buckets? How many buckets? There's a clue here. That would be the word 7, right? 7 steps, 7 buckets. Here they are. Plan properly before startup. Do most business owners have a plan? Now, I know that it sounds to a lot of people like I'm trying to get them to say no. They don't have a plan. I think most business owners have a plan. However, where do they carry it? Here. And what's my problem if I'm sitting 30 inches across the desk from you, if I'm your banker, and you got your plan up here? I can't get at it, right? I can't get at it. I can't plug in anything and export what's in your brain, right? So I wanted it written down. Monitor financial position. Too many of my customers waited till they got their financial statements. They'd whip over to the bottom of the 3rd page. They'd look at the bottom, and if there was no red ink, they'd go, we're okay for another 6 months or another year. The fact is, we've got to go inside those numbers, because there is a wealth of financial information, financial intelligence, I'll call it, decision relevant information in those numbers. We had people who look at just 2 pieces of paper, right? 2 pieces of paper, a 2-dimensional, 2 pieces of paper. We got to be able to go inside the numbers. That's my ESPN analogy. We got to go inside the numbers, and we have to have a set of tools to do that. That's where we're going here. Understand the relationship between price, volume, and cost. This comes to us from the accounting profession. I had dozens and dozens of accountants who have told me over the years, business owners don't pay enough attention to their costs. They don't pay enough attention to their costs. They don't know their cost structure. So this is courtesy of the accounting profession. I used to ask business owners, who sets the price in your business? And what was the answer? Most common answer? The competition. Well, shoot. If you follow the competition, that presumes what? They know what they're doing. And the fact is, we know that 80% of businesses out there are going to fail. So the fact is, if that's like following a lost horse. You want to follow somebody who knows what they're doing, or even better, know what you're doing yourself. Lee Iacocca from Chrysler, his comment was, in terms of management, lead, follow, or get the hell out of the way. And I wanted business owners who could lead. These tools will help us make those decisions. Manage cash flow. Is it possible to have net profits and no money? Well, I've already implied that it is, and you'll see that in just a few minutes. Is it also possible to have money and no net profits? Absolutely. It has to do with patterns. And there's only 2 or 3 key patterns. And once you get them, once you understand them, once you know how to use them, it really helps you to look out down the road and see what's happening and be predictive. Manage growth. Everybody wants their business to grow. It would practically be un-American to not want to grow. But is it possible for a business to grow too fast? Everyone has always kind of nodded their head yes. what we found is a good salesperson, a good production person, a good ops person can outsell, produce, or ops the capital structure of the business and thereby grow broke. Grow broke. That hasn't been too much of a challenge in the last 8 months, though, has it? But what's happened in the last 8 months is we're going to see the tools help us understand many businesses have been living off their working capital. And when the economy turns around, whenever that may be, whenever we can get back to doing business, maybe not normal, but in the new normal, and revenues begin to increase, we'll see that that as well can put a strain on cash flow. Many people, as the economy turns around, will say, okay, now we're past the hard part. Actually, research shows that more businesses fail in the growth cycle. These tools can help us there too. Borrow properly. Borrow properly. 2 key questions. What are they? How much? For how long? What's the most common response, as I saw in working with hundreds of business owners? When people come into the bank to ask for money, do they ask for too much or too little? Almost always too little. Almost always too little. And if we loan them too little that they've asked for, what will happen? They'll run out. And if they happen to run out right when the economy tanks, that all of a sudden could be a huge issue. How long do you need it for? Oh gosh, I don't know, LeFever. Oh, about 90 days. Wouldn't it be nice to be able to figure out how long they will need it for? The answer to all of those questions is right there in those 2 pieces of paper sitting on your desk, a balance sheet and income statement. The answers are in there. But what we tried to do and what Profit Mastery has tried to do for a very long time, you're looking at it with your eyes. You can see 2 pieces of paper. What we tried to do is give our customers a new set of eyes to see inside the numbers. What does it really mean? How's it working? And finally, plan for transition. I don't spend as much time on that. I have a transition segment, but I don't spend as much time on that. Right now, what I noticed was if you don't do 1 through 6 right, don't need 7. There isn't a business to transition. Okay, now, the title of this presentation was 4 key tools. So there's one, monitor financial position. We're going to call that ratio analysis. Amazingly powerful tool that we'll explore in just a minute. Number 2, understand the relationship between price, volume, and cost. Break even. A P&L tool. Incredibly helpful. The process. Once you understand break even, and by the way, that's going to be my expanded topic next week. Break even. How to look at the cost structure of a business and get to what's going on inside the P&L. Manage cash flow. Short term meaning less than a year. There we are. Boy, every once in a while it does that to me. Okay, and finally plan for transition. 7 steps. And the last one, manage growth. Long-term growth. We're going to call that financial gap. There's your 4 tools. Numbers 2, 3, 4, and 5. 4 tools. Put them all together and you have an incredibly powerful resource. So let's take a trip through each of those briefly. I just want to lay out how they work for you, okay? So here we go. The financial operating cycle, the big picture. The owners and the creditors get together to buy the assets, right? And we call that, of course, the balance sheet. A business owns assets for what reason? You don't collect them. You own assets for a simple reason, to create sales, right? To create sales. And we create sales to make profit. And of course, that's the P&L or the income statement. In this part of the cycle, we work real hard to make it. Now you've made it. Now what do you try to do? Hide it, right? That's tax time, right? That's tax time. You can run, but you can't hide, correct? So you pay your tax, and then what are we going to do? Every business in the entire world, What are the three things they do with profits? Number one, reinvest, right? Reinvest. Number two, repay debt. Important to bankers. Number three, take it home. And people say, well, how do you figure out how much you need? It's really hard to figure out. I say, well, it's not that hard. You know how much you know how many new assets you're going to purchase? Yeah. Great. You know how much debt you have? How much debt service you're going to pay? Yeah. You know how much you want to take home? Yeah. How do you figure out at a minimum how much profit you need? Add them up, right? Add them up. And what drives this cycle, financial operating cycle, is that word, efficiency. Businesses that run efficiently do that better than businesses that don't. I know it sounds like pretty simple, but that's the picture, okay? And what business is this that you're seeing on the screen right now? Any business, anywhere in the world. It doesn't matter. We need profits and cash, so where are we going to find them? We find profits on the P&L, cash on the balance sheet. We said they were two different cycles, the profit and cash cycle. There they are. We'll see that a little bit more here in a few minutes. Okay, so we'll get to a plan at the end of the day today, all right? So monitor financial position. Tool number one. Where do you find it? How do you do that? Well, what do you need? You need that. You need a balance sheet and an income statement. For a lot of people, they see numbers. All they see is a few numbers or a lot of numbers, and it's confusing. It's kind of like I've had people say that could be printed in Russian because I don't get any of it. It's not that hard if you got the right set of tools, kind of like a translation guide, okay? Everything you're going to see in the next few minutes comes right out of these two sheets. So we build a report card, just like back in grade school. We build a report card of all those numbers, right? I tell you, there's the formulas. 14 ratios, right? 14 ratios. There's the formulas. Most recent, a year ago, 2 years ago. And industry data. You'll see industry data in just a minute. You build yourself a report card. I will guarantee you that at least 98% of the businesses out there in America, they never do that. They never do it even once. And it's so straightforward. It's so straightforward. We do a case study with this when we do the more in-depth program, but I'm just giving you what the outcome is here. I can build a report card out of those 2 pages that you just saw. 3 years of data and the industry that he's in. And that's how I get the industry out of the RMA, Risk Management Associates. It's a book that is published every year by the banking industry. It has 1,000 pages, 1,000 different industries. Bankers use it as a guide. I'll look it up. I used to make copies of the RMA page for my various customers and give it to them. Well, you give it to them and people look at it and they go, I don't know what that means. So it's useless. So I taught them how to read it, right? What size business are you in? And there's all of your ratios, right? So that's how I build the comparative. It's not very hard. People think it's hard. It's intuitive as far as I think, and as far as most of the people who have sat through our full-blown course, they think it's intuitive as well. Then we said, okay, let's take the difference between his numbers and the industry numbers. And let's translate those differences into what? Dollars and cents. So I built this roadmap, 3 key symptoms. This, by the way, you'll find in the conference rooms of many, many companies and many organizations all around the U.S. Blow it up to a 3-foot by 2-foot size so you can find 3 key symptoms here, right? Lower declining cash, lower declining margin, lower declining profits. 3 key symptoms. keyed to the ratios on the scorecard, right? And what we did then is we took each of these boxes and said, for the ones that are relevant to a particular business, let's quantify them. Not only did we quantify them, we color-coded them. Again, visual. Red is a cash shortfall or opportunity. Blue is a profit opportunity. Gross margin, what this tells us is, by his percentage difference in gross margin, at his level of sales, if he was as good as the median of his peers, he'd have another $80,000 in profits. Then we say, where does it come from? Where are the 80,000? You can see that. Cash, 3 areas of cash: inventory, receivables, and of course, during a pandemic, if you carry receivables, what happens? In a recession, do people pay quicker? Do they pay slower? They hoard cash, don't they? So it's tougher to collect. You got to work harder at it. All we're doing is comparing him to his peers, and we're looking for opportunities. We're going to go through here and find what? Find the leaks. Find the leaks and what? Plug them. And what's that called? Find the leaks and plug them? That's called management. And we're just using 2 pieces of paper. That's all. And this, of course, turns into a what? A plan. We talked about plan. Here's the plan. Here are the opportunities from our report card. When you get a D in your report card, you know you got some work to do. That's kind of the issue. That's kind of the concept here. We know that his cash opportunities total up to $202,000, and his profit opportunities total up to $99,000. To be, when we're comparing him against the median companies in his industry, not the best, the median, we're giving him now a rifle shot approach to the management decisions that he needs to make. It's pretty straightforward. It's actually an amazing journey. That's what I said before. It is an amazing journey. Maybe even more amazing than the amazing journey on TV, because we know that 4 out of 5 businesses that start down this path, they don't make it. It's simple. How often do we do this? Oh, I did it once. No. This, as we know, anything, if you're going to change behavior, it's got to be something, not a one-off, but it happens all the time, twice a year. When my customers took this program and completed the whole 2-day program, and then they met with me, we'd meet twice a year. Even in good times, we'd meet twice a year just to keep the business tuned. In crisis times, you meet more often. I have clients in the franchising industry over the last 8 months. Their senior management has been meeting on the financials at least once a week for the last 8 months, because cash flow is so critical at this time, right? We know lots of businesses ran out of money. Well, maybe they wouldn't have had to. All I'm saying is this is a tool that can be implemented at any time. All right, so that's tool number 1, ratio analysis. Tool number 2, break even. Break even is a tool. It's a P&L tool. And all we're going to do is we're going to take a look at a traditional P&L and we're going to reconfigure it based on how the costs behave. And like I said, this is going to be my topic next week. I'm going to take a deeper dive into this particular module right here. And I'll have some little examples, a little case study, etc., that you can see on the screen. The key to break-even analysis is very simple. It's what the accountants tell us. Know your cost structure. Know your cost structure, so you can effectively react to changes in your business: price, volume, cost. We know that we live in a dynamic world. Over the last 8 months, have the cost structures of businesses changed? Every business's cost structure has changed somehow. Some of them dramatically. If you happen to be in the quick service restaurant business or the sit-down restaurant business, tremendous change in cost structure, right? So how does that affect the decision making? All right. What type of questions can break even answer? I'll give you four. And then we'll work on answering them next week, okay? Number one, if I cut or add a fixed cost, how will it impact the volume of sales I need? And of course, as the economy tanks, what do people say? Cut your costs, cut your costs. Well, sometimes they imply it's just take a chainsaw, cut them all. I say be selective. Profitable pruning is what I call it. If I have a profit goal, based on that financial operating cycle we looked at a couple of minutes ago, those three things: reinvest, repay debt, take it home. How much profit do I need? So start with that as a minimum, and we're going to work backwards to get to the sales level based on the cost structure. If I hire a new manager, how can I calculate the sales required to cover their costs? If I'm going to pay somebody $50,000, what do I have to get in sales to cover it? And what I've had people tell me is $50,000 in sales. And typically, that won't even come close. And I've had people in sessions that I've taught live over the years, they'll say, well, what's the right answer then? Kind of like, okay, you tell me what the right answer is, smart guy. And I said, well, until I know the cost structure, I can't tell you, because it will take more sales or less sales, depending on the cost structure. And if the cost structure is changing, that introduces a dynamic that we have to be aware of when we make decisions. Like I said, this is going to be a fun session for next week, okay? And finally, how can I evaluate the impact of additional expenses caused by COVID? Most businesses have had that happen. If I know what my cost structure is, it makes it possible for me to make decisions. If I'm a dental office, how much of a PPE fee do I add, right? Protective equipment, right? Protective equipment. Most dental offices have added once every 6 month charge if you go into your dentist. And they'll tell you ahead of time, well, most of them will. We've added. How did they come to that? They just pull a number out of the air? Yes, unless they actually knew their cost structure. And the dentists that have been through Profit Mastery did. So it's a 4-step process. Like I said, we'll go into it in more detail next week, but my goal this week was to just outline. First of all you need to do break even is a what? What document? A P&L. That's all you need. Everyone's got a P&L. But what I want to do is take you inside the P&L. Classify the expenses as V or F, variable or fixed, right? Determine the variable cost as a % of sales. 4 steps. Determine the contribution margin. Remember that phrase. If you don't use contribution margin, you can, and hopefully you will. It's the most important number in your P&L. We did a whole 5-year programming project with Pepsi-Cola. And that was the central phrase, contribution margin. It was all about that. And finally, then you can calculate break even in dollars or units if you have a homogeneous unit, like if you're a CPA, an hour. If you are Sport Clips, what's your unit? Heads, right? Heads. So if you're a mortician, what's your unit? It's a little more macabre. Bodies, but still, it works. It works. You got to have, now, not every business hones itself down to units, but every business we can calculate break even in dollars. So there's just a picture. Traditional variable costs, traditional fixed costs. Sales cause variable costs, they go away. What is left over, we call it the contribution margin. I just mentioned that. That's the amount that's left to cover the overhead, or the fixed costs, if you will. Here's the transition. We're going to create, and we'll do this in more detail next week. Here's the traditional accountant's P&L. Sales, cost of goods sold leaves a gross profit minus operating expenses leaves a net profit. At break even, it's zero. We're going to restructure the P&L based on how the costs behave. Not where the accountant traditionally puts them, but based on how they behave. And they will behave in one of two ways. They're going to behave either as variable or fixed. And you'll see in just a second why. Visual. I call it the cup theory. Sales fall into the what? Variable cost cup. Sales cause them, they go away. That's your cost of goods, your commissions, your royalties in the franchise world, percentage of sales. What's left trickles down. And we call that, it trickles down into the fixed cost cup, and we call that the contribution margin. And when the fixed cost cup is full, what happens? My cup runneth over, right? And it flows down to become profit. If you never fill the fixed cost cup, what's the outcome? You will never make a profit, right? Lose a little on each sale and make it up on volume. People have been trying it for a long time, but it just doesn't work. If you never fill the fixed cost cup, I had a person one time say, I said, what do you have if you never fill the fixed cost cup? And he said, a guaranteed tax shelter. The fact is, though, not going to work, is it? So, quick example, variable cost 70, fixed cost 144,000, target profit 60,000. This is what you're trying to make. There's your fixed cost, there's your variable cost as a percentage of sales. So I want to know from you, what are the required sales? I tested 2,000 of our business customers at Seattle First National Bank going back a few years. You know what percentage could answer that right? Just with writing it down? Well, another question. If fixed costs go up $1, what sales are needed, right? I tested 2,000 customers. How many of them could answer both those questions? I mean, if you know the answer, it takes you less than 2 minutes. If you don't know the answer, it doesn't matter how long time you have, right? 12%. 12%. And my colleagues at the bank said, oh my gosh, that's terrible. And I said, no, that's okay. They said, no, that's bad. I said, no, it's what? An opportunity. An opportunity to show our customers how to use these tools, okay? I'll come back. I decided to click through that because I'm going to come back next week and answer it when I talk about break even. And I've got some other examples too. All right. Number 4, cash flow. Short term. Short term meaning what? Less than 1 year. Cash flow. We've got a form. We're going to talk about net profits versus cash flow. Financial myths out there. Financial myths. If we have profits, we will have cash. Not true. If sales go up, cash is going to go up. I think that's intuitive for most business owners. They believe mostly that if sales go up, cash should rise. But it doesn't always do that. And then a sensitivity analysis. Once you've plotted it out, if you don't like what you see, what do? Change it. It's called management, right? So there's a cash flow. I know the numbers are little. Don't worry about that. I've just taken people in my core 2-day program through filling out a cash flow, which a lot of people have never done for the first time. And then we're going to graph 3 things. We're going to graph lines 1, 9, and 25. Now, there's a whole lot of numbers there, and they're probably pretty small on your screen. So you're probably sitting there going, what the heck is he talking about? So that's why I use pictures. So the myths out there, if we have profits, we'll have cash, and if sales go up, cash will go up. Let's talk about it. There they are. Now let's create a picture. Lines 1, 9, and 25 on my cash flow form. There's line 1, sales. There's line 9, profits. There's line 25, cash. The goal of this section is to plot and explain the difference between profits excuse me, and cash. Clearly, they're not the same. Clearly, they're not the same. When people think they're the same, you can't look at that picture and think it's the same because it doesn't look anything like it. Which one is more volatile, profits or cash? Clearly, cash is more volatile. And as I said at the very beginning of my presentation here, nobody ever walked into the bank and said, I'm here at the bank because I'm out of profits. What they're out of is cash. Isn't that right? And we want to talk about what are the drivers there. That's all. And then I asked people some questions. What would happen to cash after April if sales continue to go up? Like so. Again, people have in their head these beliefs. Well, intuitively, it seems like da-da-da-da-da. I got to tell you, finance is not an intuitive concept. Finance is like physics, according to finite rules that it follows. And what we find is profits show up on the P&L. Cash shows up on the balance sheet. That's the difference. And it takes money to create those sales. And what happens is you have to buy the assets to support the sales before you can bring them through the P&L and turn them into profit. So there's a lag. How big is the lag? That depends on the management skills of the person driving the bus. But we can plot it out. And then we can change. And in this case, we can change. I changed inventory and receivables, which are the two big drivers of cash flow, typically. I did a 60-day, and my maximum borrowing was $220,000, and my ending cash was $7,000, roughly. Then I changed the collection period to 45 days, an improvement of 2 weeks. The maximum borrowing dropped to 135, and the ending cash shot up to 50. And I said, go to 30 days. Well, then all you have to borrow is 75, and you end up with 93. So I said to go from 60 to 30, that's an improvement of 30 days. To go from 7,000 to 93,000 is an improvement of $86,000. And I rounded that to 90, and I said 30 days equates to $90,000 of cash. So 1 day equates to 3,000. And then let's just say that on my Risk Management Associates comparative industry data ratios, the industry is paying at 42 days. So he is paying at 60 days. I'm sorry, he's collecting at 60 days. If he can get it down to 42 days, that's improvement of how many days? Why be a softer touch than the industry? Again, industry data helps. Well, that's an improvement of 18 days. If 1 day is 3,000, 18 days, the difference is going to be 54,000 that you don't need to borrow. As a banker, I want to loan my customer money to help them grow. I do not want to loan them money to subsidize their inefficiencies, pure and simple. So that's short-term cash flow. The financial education life cycle that we're learning right now over the past 8 months in this country and pretty much worldwide. Here's what people think. Most important number is sales. Second most important is profit. Oh yeah, and there's cash flow too. So here's what everybody's learning, sometimes the hard way. You can afford decreased profits if you have cash flow. But the reverse is not true. We've had decreased profits in our company, no doubt about it. But we have cash flow because of the way we've structured our relationships, specifically because of this pandemic. So the message, very simple. Sales is actually third most important in these days. Profits is second most important. And what's king? Oh yeah, cash flow. Cash flow. So let's look at a tool that helps us manage cash flow long-term really well on the balance sheet. It's called financial gap. Financial gap. Right there. Manage growth, and when I say capital efficiency, all I'm really meaning is during a downturn, there are a number of companies that if they can't look outward and increase sales, they look inward and say, let's get our house in order. Let's get our house in order. Or companies today are looking internally and saying, what? Let's revise our house. Let's look at what we can do in the new conditions. What's the most common word that has been used in the business community since the 15th of March in this country? I believe it's this word right here. Pivot. Pivot. Everyone uses that word now. I see it everywhere, meaning we've got to change. How do you change? You got to know your numbers so you know where you can change and what the impact will be if you do. So I love this section, by the way. This has been my favorite section for years. And my third session, not today, not in a week, but in 2 weeks, I'm going to talk about that right there in more depth, okay? So there's the financial operating cycle. It goes this way, which is counterclockwise, right? The owners and the creditors put up the money to buy the assets. We own assets to create sales, sales to create a profit, like so. Now, we got to go the other way. Sales cause a need for assets, which cause a need for sources of money to buy the assets. This linkage right here between the balance sheet and the income statement, it is the secret to the ice cream. To recognize that linkage is so important and understand how it works. We're going back. Sales cause a need for assets, which cause a need for sources of money to buy the assets. And what are those 4 sources of money? A bank loan, the bank, obviously, net profit, retained earnings that are kept in the business. Of course, most of us strip out the earnings because the accountant tells us to make the tax low. So if we look at the International Franchise Association, the chairwoman there is a woman that I have worked with for 20-some years at the various franchise networks that she's the CEO of, Catherine Monson. She did a presentation about 3-4 years ago. She talked about our firm at the IFA International Convention. And she said, Profit Mastery not only helps businesses focus on improving or maintaining profitability, but to understand the balance sheet ratios and the importance of cash and the need to accumulate it. Very prophetic 3 years ago, wasn't it? Well, it's still true, except it's harder to do now because of a challenging economy. New equity, put some of your own money in the business. It's hard to put money in when people are scared, when they're anxious, when they're confused. This can clarify things, this process. And finally, trade credit. Go to your vendors. If you sell a lot of their product, ask them to help you. Don't just not pay them. Ask them to help you. They'll do it. Not all of them, not all the time. Those are the 4 sources. That's it. Okay. Here's how it's going to work in 2 weeks when we do this program, but I want you to understand now, which is what I said, an overview. We're going to go down the left-hand side of the balance sheet, buying the assets. We're going to go across. We're going to go up the right-hand side, doing what? Buying, paying for them. And the last entry is going to be called what? Financial gap. The amount of money the bank's going to be asked to put in. What does this look like? Down, across, and up. What color are those arrows? Yellow. Follow the what? Think the Wizard of Oz. Follow the yellow brick road, right? down, across, and up. And it'll end you up right there. And you'll then know how much you need to borrow. It might be too much for the bank to loan you. Then you got to go back and figure out a way to do it more efficiently, manage the business better. We're going to do that in 2 weeks. It'll be a fun trip. Okay, so in our little case study, we start out owing 0. Then once we projected going from 600,000 to 900,000 at this level of efficiency right here, we're going to need to borrow 126. We calculate the ratios, and we know that his ability, the quality of his balance sheet is weaker. And I'll talk about that in 2 weeks as well. I'm just giving you an outline of the relatively straightforward actions you can take with 2 pieces of paper. Instead of sitting there wondering, you can do this. And then we're going to go to 1.6 million, and that's gonna tip over the whole barrel here. That's going to tip over the whole barrel. Growing broke. In 2 weeks, I'll actually show how that happens. Right now, just a diagram. Sales going up, we need more assets. When assets go up, cash goes down. When cash goes down, liabilities go up. That's the skeleton framework. Around that, we wrap the numbers of our business. It's really pretty straightforward. There's the big picture, but we'll do it in 2 weeks, okay? Sponge technique. My creation. If you don't like what you see on the balance sheet, what do? Change it. So I list the 10 things. We'll talk about them in 2 weeks, right? So what I said was, here's my 900,000 in sales unmanaged. Here's my 900,000 in sales managing the inventory, the receivables, right? The receivables more efficiently, a bit more efficiently, making a slight bit more profit, not a lot. We get the note payable from 126 back down to 0. And when I look at the ratios, 900 unmanaged, 900 managed, a much stronger balance sheet. Again, I'm just giving you an overview of what can happen when you have the tools, of finance. All right, so let's wrap this up. We're right at about an hour, so that's about right. Borrow properly. People have said to me, well, you were a banker. Why should people have to know how to borrow properly? Because you're the one who's lending the money. I said, yes, I am. But you're the one who's putting your personal guarantee on the loan document. You ought to know what you're borrowing. You ought to know what the implications are. Bankability. A friend of mine who's a senior banker in the Midwest. I talk with him every January. My talk this January was kind of fruitless because we had no idea what was coming at the end of February, did we? But I said, what's going on and what should I be telling business owners as I travel around teaching? He said, tell them that borrowing is a privilege, not a right. First, you have to earn it, right? Remember John Hausman and his ad? Know your numbers or stay home. The things we've just done in 1 simple hour are the numbers you need to know. They are the numbers you need to know. Here's a debt structure, and I'll come back to that in a couple of weeks as well. What kind of asset are you buying? How are you going to finance it? How are you going to pay it off? Pretty simple. Fixed assets, you pay them off with long-term debt, and you pay them off out of profits. Permanent working capital. These are the pieces of inventory and receivables that go up. Even if you're in a seasonal business and growing, go to your vendors. And if not, 3 to 5 years. Not long term, like 15 or 20 with real estate, 3 to 5 years, but more than 1 year. And if it's more than a year, you're paying it off out of profits. And then that seasonal part, line of credit, and it's paid off out of cash flow, not profits. Pretty simple. I often thought this should be a henna tattoo that everybody puts on their arm. Just like the football quarterback that comes out, we're watching, if you watch on Sunday, they got that little book on their arm, and they open, when they give you the signal from the sideline, they open up to the playbook and they know what to call. This is the playbook that every banker and every business owner should be aware of. Sample loan package, pretty simple. This is pretty intuitive. How much you need, what are you going to do with it, when do you pay it back, how will you pay it back, profits or cash, and what if something goes wrong? What is plan B? I didn't know we're supposed to have a plan B. You always need a plan B. Otherwise, how can you possibly pivot, right? Okay, we'll wrap up right here. Strategic planning roadmap. This is module 2 from Profit Mastery. This is module 3 from Profit Mastery, right? Where have you been? That's the past. This is the present. Variable fixed cost target profit gives me the what? Needed sales. Once I know the needed sales, I got to have a marketing plan. And by the way, those of us in smaller businesses, I just talked about the financial piece and a marketing plan. Those are 2 different hats. Which do you all wear? I think most small business owners or independent business owners, they wear a little bit of all of them, don't they? You got to have a lot of hats. But the one that's usually worn the least is finance. And it's right now the one that is the most important. And while we're doing the plan, we want to do a cash flow to make sure we stay in business. And then once we know the needed sales, we're going to do a financial gap analysis and figure out if we need any money. And if we need any money, then in module 6, we can put a loan package together with all these pieces interrelated. It makes sense, it hangs together, it works. It's intuitive. And if you do this for a really long time, effectively, what can you do in module 7? You can die. But you got to have a plan. That's the point here. That's essentially the profit mastery process. Market-driven business constantly seeks to meet the current and emerging needs of the market it serves by developing and implementing solutions that are innovative, flexible, and scalable. Jim Donnelly was a good friend of mine, passed away from throat cancer here a few years ago, but he taught at the Graduate School of Banking with me in Madison. I've been there 30 years now. You got to be flexible. You got to be able to understand where you are, and then that'll tell you what options you have. Why doesn't this happen? Pretty simple. People said, I don't have time. Newsflash. Each of us has all the time there is. Pure and simple. I don't know how. Baloney. Business owners are smart people. Oftentimes, they simply haven't been given the tools. And I can guarantee you that profit mastery is the tools. If it was important, my accountant would do it. Does your CPA sign your note at the bank? I don't think so. In fact, we've had 20,000 CPAs take this program so they can help their clients better and work with in your world, your SBDC counselors. Most of them have been through this whole profit mastery program. They can help you. Talk to them. They're all across the United States, not just in Wyoming. It's not fun. I happen to think this is fun. Now, maybe I've got a deranged view of fun, but this is an amazing journey. This is an amazing journey, and people who can do it successfully, they're geniuses. They are. I was told one time, one of my customers said, I'm more of a crisis manager. And I'm thinking, what? Well, that's a darn good thing, brother, because you got one, so swing into gear. You ought to be at the top of your game. You're in deep kimchi. So, you got 2 choices. Leave your head in or pull your head out, right? Pretty simple. 2 more shots at this in the smaller version, the webinar version. It's a new world in terms of identifying and managing post-pandemic cost structures in your business. Strategic insights on how to do it and how to use it. we're going to get to what I call the magic number, okay? That's next Tuesday. And then working capital challenges in the post-COVID-19 economy. We're going to do financial gap as well. We're going to expand those two sections, Module 3 and Module 5. That's where we're going, okay? And in the meantime, keep in mind something. It's a journey. We're all on a journey. Not everybody makes it. Kind of like heading out in the 1840s from St. Louis to California. Just because there was gold out there, some people just didn't quite get over Donner Pass, did they? It's a journey from profit mystery. Sometimes you got to change one thing, just a little pivot. Change one letter to profit mastery. And if he were here, the founder of Nike, what would he say down in Oregon there? He'd say, just do it. And that's what I can tell you. Just do it. I can tell you this. If you apply these tools, if you learn them and apply them, you will be a better business owner. You will learn something about your business. I can't tell you whether that will be good news or bad news, but knowing is better than not knowing. Not knowing, I had a picture of just a minute ago, sticking your head in the sand and hoping it gets better. That leaves a significant portion of your anatomy exposed. And in this uncertain economy, being exposed is not a great thing. So hopefully I'll see you next week. If you have folks, friends, other business owners around you, and you like this, let them know. We got room for as many people as you can bring in. All right, thanks very much, and I'll see you in a week.